Sunday morning, the weather is fine, sunny today, a bit windy though, but we'll take it. Nonetheless, it's time for another weekly market recap. Now, I like to say that it's going to be a quick one, but I'm going to tell you, it's not really. It was a pretty eventful week. We got a lot of data points coming in. Markets, as for price action, they moved as expected. I mean, there wasn't really a huge surprise, if not maybe in, well, bonds, but I mean, would you call it a surprise? They just kept on bleeding lower. So let's start out with the economic calendar as usual. And what we got was on Tuesday, jobs, so job openings in the US. And as you can see, they're still coming down. So less jobs created, or at least, these tracked the new positions open basically. So not not particularly good, but I mean, it wasn't good even before, right? It was coming down anyway, and it peaked in 2022. Then what we got was ADP non-farm employment change, and again, not particularly good. I mean, the trend is down. I mean, it got a little bit of an uptick, but all in all, it wasn't particularly huge. Um, Now, before we go ahead, this could have been the most controversial week when it comes down to data points and actual figures which have been released. And now, before moving to the others, for each one of them, I'm going to try to come up with a screenshot I captured throughout the week and see if we got something more uh, that can be, digged out, like, investigated below the surface. Sure, it's no big secret. You can basically find these type of critical informations or critical thinking type of views, whatever on the internet. I happen to use like Zero Edge a lot. It's not because I love Zero Edge. It's just, more often than not, they're very good at going in depth. And it doesn't mathematically assumes that I'm always be in agreement with them, but just to name one, okay? So let's have a look at these. So it looks like the jolts were particularly weak, as we've seen, but the ADP was particularly over expectations, right? Now, of course, if you take a look at the chart, you can see the same as we were looking at the browser in the Forex Factory calendar. Now here we are kind of pointing and hinting at the fact that there are a lot of seasonality type of adjustments in these label data, especially this time of the year, because since we got the data particularly early compared to other months, because everything basically came in um, at and around the end of the month or the new day of the new month, so the 1st of November. So even when you go out there collecting the data, the process is a little bit different in terms of the timing of it. All right. So many things could be a little bit different when you're going to look at revisions or adjustments down the road. Could be next week, could be next month, next quarter, whatever. And don't get me started with revisions because it was a crazy week for revisions, right? So anyway, that was kind of a little bit of a note for the ADP and the JOLTS. So let's move on. We got GDP. Now, GDP was kind of in line with expectations. I guess we lost for 20 basis points. It went down to 2.8 instead of 3%. But, at the end of it, if you consider the US economy growing above 2.5% and, closer to 3 than 2, it's already an outstanding result for a mature economy like the US. The only problem with that, if you have checked any mainstream media at this point, is that it looks like one of the greatest component of this figure uh, was defense spending. So, all the weaponry, the missiles, the bullets, the machinery, the tool of war, right? Which the US is kindly sending all around the globe. Could be Israel, could be Ukraine. But anyway, it looks like that type of expense was a relevant part of the GDP number. Now, the only one problem I got with GDP is it's kind of like the same I got with inflation more often than not. And the thing for me is, as for the CPI, GDP, it's not a good leading indicator. I mean, it's just a depiction of what happened over the last quarter, essentially. And when you get the figure, you're looking at what happened 2, 3 months ago. You're always looking in the rear mirror, right? And the assumption that just because GDP as a data point is good now, it's automatically going to be good into the future. It's completely false. Um, I borrowed a few screenshots from Jeff Snyder at Eurodollar University. There is not a lot to explain apart from the the faces that he always puts in. Very very funny, I guess. A little bit of irony, right? But if you just look at what GDP was, and this is taking a look at the nominal GDP, which is the shadow in the background, and the real GDP, which is the one, let's say, up front, right? You can see that before major downturns, recessions, or whatnot, GDP was always kind of cool, right? This is the most recent one in 2020, right before the recession, the COVID pandemic. And you might say, well, okay, but that was the pandemic. Yeah, okay, let's go back in time then. This was, I guess, 2008. As you can see, the nominal was growing at 5%, just to then go through the worst financial crisis, recession of the last, what, 50, 60, 70 years, right? And again, you can keep on going back in time. This is the 2000, so the dot-com bust. And again, you see the economy is growing both nominally and in real terms. And then look what happens, right? Again, the in this case, the red shaded areas are recessions, at least has declared by the entity in the US, which is in charge of declaring recessions, right? Um, could go even further back in time. You can look at the 90s, and you can just check the numbers for yourself, right? You can look at what happened in the 70s, right? 70s was a particular period, right? Inflation, oil embargoes, and Yankee Pool and whatnot, right? So this just shows you that, in a nutshell, GDP it's not a good leading indicator, right? And it shouldn't be used as a safe type of a forecast to extrapolate uh, data coming in into the future. All right, so just these, right? Then we got well, yeah, we got PCE, the Fed favorite gauge of inflation expectations, and it came back to levels which are particularly good. I mean, the trend is always on the disinflationary side of things. I got a chart for it too, which basically shows you that right now PCE came back in that range where it was basically since 2010, 2020. Now the average, of course, is the dotted trend line right here, and then you got your standard deviations to the upside and the downside. But just to prove at the point that it looks like the trajectory for inflation is now back into what the Fed might start to consider an achieved victory over inflation. So therefore, again, more rate cuts down the road, just based on that alone, right? We are back into the target limits, so we can quote unquote normalize monetary policy. And if you take a look at Fed Watch for Fed funds futures, it looks like the market it's now pricing in another what 20 25 basis points cut, right? Yeah. The current is, yeah, 475, 5, and it should go to 450, 470. Yeah, so 25 basis points cut for the targeted range, right? So looks as expected, right? Now, I don't think there is a doubt about uh, the trajectory of inflation and this inflationary trend we have been in for months now. Although, again, if you check the thumbnail and the title, it looks like someone is not completely agreeing with that. But more on that later on. So then we got unemployment claims as usual. Um, there was something about them which what was that? Maybe this one. Let's have a look. Yeah, basically there is a little bit of a relationship in between the initial and the continuing claims. Um, and if you compare them together, if you try to look at them in the same picture, basically the end result is that there is not a huge surge in lays off, right? But at the same time, those people which are just let go, which are fired, they are struggling a bit finding a new job, right? Because you just see that both data points, both charts are coming up. So first, it might have been that, yeah, you got a few people which were fired, but the continuing claims were going down, which means that you might hit the unemployment line for a while, but then you find a new job. So you come off the unemployment line and you're not longer registered into the data. Now it looks like people which are fired are really struggling compared to, let's say, 3 months, 6 months, 1 year ago to get a new job. And I guess the dynamic is supported also by the fact that if you look at the number of quits, they are really coming down, which means if people are not voluntarily quitting their jobs, that just means that they don't think they can find a better or another opportunity elsewhere, which is why they are holding on to that job, even if maybe they don't like it, or maybe they would like to have a raise or to have better working conditions or whatnot. But still is irrelevant data in my view, right? Then I guess the darling of the week was NFP. NFP came in massively below expectations, and it looks like the September data point at this stage was just the outlier. And look, it's not just about the forecast and then the actual data point, but the big thing here, in my view, as usual, we've now used to it. We are now used to it. The big thing is in the revisions, and let's have a look at these, for instance. Now, if you look, I got a handful of screenshots right here. Let's start out with these. Now, first of all, the private payrolls was negative, right? And this is something you need to go back in time to 2020 to see. Um, because of course the aggregate, the data, the number, the figure for NFP is just an aggregate, right? Then you could break it down to the private sector, the public sector, or you could break it down by, I don't know, constructions, or manufacturing, all the different sectors of the economy, right? But it looks like overall the private sector came negative, which is not good because if the data is slightly positive, right, but the private sector alone is negative, where is the difference? I'd say public jobs, right? So again, we went over it a few weeks back, but in a healthy economy, you would like to see the private sector adding jobs to the overall economy, not the government, all right? And yeah, these were the revisions, of course. I mean, if you start to look at the numbers, they have been particularly substantial. All right. So again, is it another way to cook the books when the headline is released and then coming back to it later on? Say, oh, you know what? You remember that strong figure 3 months ago? No, forget it. Actually, it wasn't like that. We're actually revising it down now. So sorry, our mistake. Again, now beyond the irony, this is not good. I mean, when you start to get a trend in revisions like these, it's, it's not only it's not good, but you start to wonder who the fuck is measuring these data points? What type of a process they got to calculate them? I, I mean, if you have to continuously revise them, don't you ever think that maybe you should change something around in the way you calculate them in the first place? So maybe, I don't know, next time you're going to have a number or a figure which is much closer to reality, and you're not going to be forced to get back to it later on and revise it. I mean, it doesn't make any fucking sense to me at all, but what are you going to do, right? Then still looking at NFPs, what we got. I mean, there was these. Look at average hourly earnings, and again, they ticked up a little bit, but they're still downtrending. Uh, it was strange to some degree because I've seen, and I actually got a screenshot for it, but do I want to? Do I want to take it up? I don't know. It was a little bit of a joke, but I know people get offended particularly quickly when you mention politics. Um, you know what? Forget it. I'm gonna do it. It was on Thursday, I guess. I was just randomly talking on Discord, right? I was looking at the data coming in, so I was noticing, okay, personal income up, right? Personal spending up, but you know, and then of course we already got PCE, right? It was Thursday, so everything was kind of fine. Jobless claims down, of course, because the hurricane and whatnot. So it was looking like, okay, so people are making more money and people are spending more money, but PC is down into the target range, so it's all good, right? It's all good, right? It's completely cool. We solved the problem of inflation. We got people back to work and they are making more money, they're spending more money, but at the same time, the economy is not running too hot, so inflation is not going to be a problem, right? And again, it was just kind of like, yeah, see that, see what great of a job we've done. When you go to the voting ballots, you know who you need to vote for, right? But anyway, that was assuming that NFP would have come in massively exceeding expectations, which didn't. So, I mean, it was just a little bit of a joke, all right? So, um, getting back to serious stuff. Oh, yeah, these are the sectors, right? So you can see that basically the only two things actually adding job in October was healthcare and, of course, government. If you look at, I mean, even temporary jobs, right? Temporary employment, it went down. We already seen that phenomenon where you got full-time jobs decreasing and part-time jobs increasing, right? And that wasn't good, all right? Because the dynamics are different. When you got a full-time job, even the benefits that you got are different, are higher. When you got a part-time job, it's not cool. Plus, it's not cool that you gotta have two, three, four or more part-time job in order to make ends meet. While in normal circumstances, you just got one job and it's enough to sustain you and maybe your family or your partner or whatever. So again, now we are looking at the same dynamic, but even for temporary jobs. So if you run a business, right? Who do you think it's easier to get rid of? Well, temporary job, right? They are temporary anyway. It's not like you have to fire an employee which is working for you for decades. that guy, right? Temporary, so just don't renew it. Just get rid of him, right? But still, it is a testimony of the fact that people which are running business are really trying to cut the costs where they can. And usually you cut costs when you don't get revenues, right? So again, getting to the through these data, it just tells you that I guess something is really brewing deep down, even into the labor market, which is usually historically it's the last shoe to drop, right? So I guess not cool. Unemployment rate came in at 4.1, so in line with expectations. And well, the ISM manufacturing was again in contraction territory once again. Now, you might say unemployment is not that big of a deal at the current moment in time, just though one simple thing. If you look at his tweet, and if you look at how they round the numbers, yeah, you read 4.1, but I mean, look at that. It went up almost 10 basis point at the end of it, which maybe it's not a lot, maybe it's not that big of a deal, but still, it went up. And the only reason why it appears flat when you look at the headline is because of a rounding mechanism. All right. So again, I guess again, it just to put out there that the market might trade on the headline one way or the other, right? Markets tend to have that knee-jerk reaction when the headline comes out, but don't be surprised, especially if you're an intraday trader like I am. Don't be surprised if you see the market move in one direction when the data comes in, and then let's say after what? Sometimes it's just 5 minutes, sometimes it could be an hour, but or sometimes it could be the next day. Bear in mind that market participants need to go through every report, right? And they are doing the same thing you are looking at me doing now. They're digging to see if beyond the headline there is something more. And if they find something more, and if that something more it's kind of contradicting the initial thesis they might have, they're gonna readjust their behaviors in markets or their positioning. So, just pay attention to it. Now, after all of these data, right? Let's have a look at markets because I do know people are bored when you talk about data, when you look at charts, when you look at figures and numbers and shit. Uh, I'm feeling particularly ranty this morning. I don't know why. But anyway, people just want to know where price is going to go so they can make more money, so they don't have to think for themselves and whatnot. All right, so let's do that. I mean, supposedly, we don't know where the market is going to go, right? It's just an assumption. It's always a matter of probabilities, right? It's a matter of odds. Nobody knows the future. So let's look at currencies. The DXY closed on strength on Friday, and I guess, I mean, looking at the others, um, still a little bit of upside potential up until the point it can maintain the AQ of the macro range we have discussed so many times. So I'm not going to zoom out once again because at this point you should know what I'm talking about. If you don't, I'm sorry, you're late. You should just go back to the previous videos and watch them. The euro conversely had a down closing Friday, but I mean it was drawing back the down leg throughout the rest of the week. So maybe a little bit of a little bit more of this one of this type of behavior, probably slowly drawing back a little bit more. I mean the best case scenario for the euro, right? Uh, the pound actually went for new low, and so new low on the pound, not in the euro. It's a little bit of a shift in the relative strength, maybe. Could be. I mean, these stuff tend to ebbs and flows around, right? So uh, it's not uncommon. The yen. Everyone is forgetting about the yen as Do I have it inverted or not? No. Or maybe yes. No, yeah, yeah, I got it inverted. It's fine. It's going down. Yeah. Um, Again, it's following the others, but the yen is a huge component of the overall index, the DXY. So again, for now, to carry trade, unwinding, not a huge risk. At least nothing which can be perceived in the price action. Right. Let's have a look at gold. Gold again had a nice week, but got a reversal Thursday, and it's now hovering around the previous shelf. I just highlighted these three levels right here because I think, I'm just using them to kind of grasp what could come next. What I mean by that, let's say if you see gold kind of drawing back a little bit more, right, into this level right here, and yeah, could reaccumulates that or around that, and then it starts to tick up again. That's still good for gold, in my view. If you see it coming back down right here, right, trying to rally and failing to get back into this previous structure, let's call it like that, then you might get gold keep on consolidating in here for a while. Again, we have seen what happened in here, right? It's not something which cannot happen. Um, and if you see it starting to break supports and confirming supports as flipped resistance and keep on coming back down, like could be these, right? Then you know something's up with gold. Now, for now, I'm looking at this level right here. It's the most crucial one for me. So the 2,600-ish, more or less. I would be willing to wait for gold to break that level before actually calling a top put in, which could be short term, could be long term, who knows? Still would be an apex for me at this point, and should have to readjust my positions at that point. Now, again, this one right here, right? If you see the market coming back down, then retesting it, failing, and keep on going down, you could start to categorize this one as an apex. That would be true. Technically, in my view, that would be true, but it's kind of like up until the point this area doesn't give in. I would see it, as I said, for Bitcoin and oil as a trapped fractal. So that would be the bullish fractal right here, and you would have the bearish fractal to the upside. And up until the point price would be stuck into this range, it would be trapped. And for me, it would be kind of a neutral type of a bias, waiting for it to break one direction or the other, right? Let's have a look at oil. Again, even oil, I was expecting it to be a little bit more choppy, especially opening up the week, but it just gapped down. It gapped down, it tried to rally, it got back into previous, let's say at this point, support, right? And it closed the week with a rejection on Friday after trying to push higher, and it was faded. So all in all, it didn't really play out the way I was expecting it. I was expecting it a little bit more choppy and then trying to go down. It actually went down right off the bat and came back up to retest the breaking point. And so far, it's been rejected. Still, at the end of it, it still fits my kind of bias or slightly bearish oriented thesis for oil. So not the way I was expecting it, but still, direction was on the right side. I'd say. Um, we are still looking at these divergence on the break evens, and now break evens they actually broke out of these uh, uh, structure range, previous highs. You can call it whatever you want, and it looks like it's going up now. Break evens reflects inflation expectations into the futures, right? So I guess it's kind of normal they're ticking up at the current moment in time because if you check yields, they're doing the same. So it looks like inflation expectations are a little bit reignited. But I really want to talk about that at the end of the video. All right. So as for now, I take this one as a potential warning sign on oil. And basically what I'm waiting for is for price to kind of confirm the uptick in inflation expectations. So it could be something like, over the next weeks, something like it, to see the oil market failing to go down and actually trying to put up a little bit of a rounded bottom, right? And at that point, if it gets back in line with the break evens, if the break evens are still trending to the upside, I might say, you know what, I should reconsider a little bit, or I should reassess my bearish expectations for oil. Okay. Bitcoin just did what it needed to be. Just did what it needed to do. It went up straight to target, and again, it's kind of like the same of oil. I was expecting a little bit more of a choppiness early in the week. No, it just Monday, Tuesday, boom, took it. Um, this is strange. I got a few questions for it. Uh, now, look, honestly, and I'm being totally honest here, my target was this swing right here, right? And not the ultimate all-time high, just because I was looking at this pocket of liquidity right here. And I was saying, well, this is my ideal target, but of what you usually get when equal highs like these are actually taken out is a little bit of an overshoot. And there is this clean swing. It's very lonely. It's very isolated. It doesn't have a lot nearby. So I said, you know what? It might overshoot to the next target, but I don't feel confident enough to pronounce myself on the all-time high. All-time high is always a very delicate type of a level in my view. Um, so if you are coming off of a structure like this, very long-term structure, my initial target, it's probably never gonna be the ultimate high. I want to see if there is something near that which constitute a good place for stitch up, for a stitch up in market. Uh, and I identified these and these, which is why I was looking at it. It was perfect. Like, I wouldn't consider it a swing failure pattern, not yet. I mean, if you're thinking about a bull trap, I guess the icing on the cake would have been taking out the ultimate high. Um, if you just think that we took out a relevant high or two highs right here, we got a decent pool of liquidity, and we are getting into the elections Monday, Tuesday, and the market just decided to kind of play it safe, like, I was long, maybe from here, whatever. We got this target. I'm gonna take profits and see how the elections go, right? That could be. Now, at the current moment in time, it's not particularly, let's say, in danger up until the point it can hold this area, right? It was particularly extended, right? Like 1, 2 days like these. So it drew back into the liquidity base at this level. So up until the point it stays around here and maybe consolidates around here, to me, it's still good. Now, of course, if it starts to crack it, I will look farther down into the old pocket below. So basically, in this range once again. This is a good point to just hint at the fact that next week, especially the beginning of the week, expect everything. I'm not even sure I'm actually going to trade. Uh, Look, the opportunities will be wild, okay? Because when you got a lot of volatility, you usually have a lot of opportunities. Um, Part of me would be like, man, intraday would be crazy. Intraday, you'll get whole type of moves you could collect, like 50, 60, 80 points move on NQ, like snap of a finger. But I'm a little bit concerned about liquidity conditions. So I don't like engaging in markets where the spread could go nuts from one moment to the other, or you might get potential huge leakages. So I'm still considering whether I do want to trade on Monday, Tuesday, or not. Um, so again, just to say that, and same goes for all the other assets. This thought popped into my mind now because we are looking at Bitcoin, and Bitcoin is of course less liquid compared to other assets, right? So just um, just that. Let's have a look at indices, the majors, and even in here. I mean, I guess it's one of the rare weeks where basically everything works out, right? If you remember last week video, pretty much everything went as expected. Um, like we got targets for the Dow in the 41 750-ish area. We're not there yet. We might spike into it Monday, Tuesday, right, for the increased volatility. I still think if you look at the Nasdaq that these lows are a good target. Again, because of volatility, that there would be a good pool of liquidity to unload eventual shorts that have been taken on in this region. And ES, they got ES has the same type of lows plus a little bit of a gap below, right above this base, and then you got this huge balance price range right in here. So, I mean, just for the sake of the elections, as I said last week, I still think there is a little bit of risk to the downside. Um, if you check the ETFs, what you see is that you might remember last week we just broke out of the wedge. We retested it on a Friday for the yes, and what was it? And Friday for uh, uh, the triple Qs as well, and we rejected that. So I said, you know what? If there was the possibility of breaking the dynamic support of the moving average. Um, and of course, there was the lower moving average, the 55 exponential. We kind of tagged right into it, right? And if you look at the ATFs and you compare them to the price action on futures, basically that that area right here would be this one, basically, right? Below the lows into these open gap. And for NQ, it would be right around the 100-day moving average. So another line of support. Yes, or SPY. Oh, the 100-day moving average is a bit lower on this one. Just remember, we are operating on a little bit of a breaking correlation SMT, which at the current moment in time sees SPY or ES weaker than NQ or the triple Qs. It was pretty evident in here throughout the week. Let's try to zoom out on a 4 hour. There you go. So possibly a little bit more of a downside potential on ES and SPY compared to NQ. Could be. All right. Now just forget my stupid notes. No, because usually throughout the week I check these break in correlations on many different time frames. Like if you check in here, we got the 15 minutes, and so I do remember what was that? I guess. Oh, well, maybe it was last Thursday, I guess. But just to give you the gist of it, right? we could check this one right here. You see that at the European Open, ES goes for new lows while NQ doesn't, and therefore NQ later on in the day it takes out the previous high, and these are the relevant high right here, while ES just doesn't, right? And then when they came back down after it, you've seen that NQ closed particularly far away to the upside from the lows, while ES traded for new lows for the day. So again, just a little bit of that to grasp the relative strength. It was particularly evident even on Friday, where you got the initial pump at the open, NQ and the Dow, they both went for new highs. ES didn't, so therefore NQ closed well above the open. The Dow never touched back into the open. ES actually did, and it closed below the open. So just a little bit of a tool that I use throughout the trading week. Now, I think ultimately that we might get another little bit of a downside attempt, and after that we'll see what comes next. I'm very hesitant in making any sort of a call at this point because this is, at least for me, I'm sure other people might have a little bit more of experience with it, but this is really the first election year that I go through while having real capital on the line and while having a decent amount of months under my belt when it comes down to trading. So, 2020, I was already trading, but it wasn't really at the same level or at the same stage I am right now. So, let's just say this is the first real election that I can witness with money on the line, even for the long term, because you know about gold, you know about the bonds, and you know about the DXY, the dollar positions I got. And while actively trading intraday with a lot more frequency compared to what I was doing before. So on one side, I'm excited about it. It's a new thing. It's a new opportunity to learn stuff, to engage, possibly if I see the opportunity. But it's really fascinating to me because I feel like now I'm able to look at the market and how it's moving in relation with these elections, right? But now it has it's kind of like I'm looking to it through different lenses compared to 4 years ago. So uh, part of me would be more inclined to just watch it, like watching a movie, instead of trying to take on a lot of risk to make a lot of money. I don't care about. I mean, I can make money any other day if I keep on doing this. But I mean, I don't know. It's a strange phenomenon, to be fair. I was thinking about it this week. This week it was like Friday was national festivity in Italy, so I took the day off. Um, but trading throughout the week, I was like, we are getting closer and closer to the elections, and you can see the market is moving particularly volatile. It's going to be great, right? I wonder what's going to come next. Yeah, all right. Enough about me. Let's look at yields. And yields closed on strength. So again, kind of like we were looking at the break evens, right? Inflation expectations still going up, and conversely, the futures for the U.S. Treasuries. I switched to futures just to have a little bit of a clean chart, right? Because the ones I had for the ETFs were a little bit messy. Plus, I wanted to look at something which is, um, in my opinion, maybe a little bit more reactive. The futures market is usually a bit more reactive, I guess, compared to spot, or at least that was that was the feeling that I got looking at these different charts side by side. I I might be wrong, yeah, but that was just the first impression, so I want to give it a go. Um, yeah, they have been crashed. Yeah, that's it. Now, which brings me to the thumbnail. Now, if you check on Google, this interview from Paul Tudor Jones went viral in a minute, right? So it looks like all roads lead to inflation. So of course I'm long Bitcoin, I'm long the Nasdaq, I'm short U.S. Treasuries and whatnot. Okay, now regardless what you think about, I mean you might have your own thesis, right? Everyone does it. Um, I I wasn't that surprised about the conclusion, right? I mean, all many people out there are convinced that we are gonna have inflation like in the 70s. So it wasn't the conclusion, it wasn't the statement which got to me. It was, well, firstly, Paul Tudor Jones. If you don't know him, I guess you have not been around finance for a long time. um, which is again, which is not a capital C, but just it is just one of the greatest investors and traders of all time. Getting back to the late 80s up until now, he made a fortune in markets. So um, what I wasn't particularly convinced of was the reasoning he was adding, the logic behind his conclusions. So he was talking about the deficit for the US, the problem with the debt, right? Uh, Potentially foreigners, so the rest of the world rejecting US treasuries, and therefore yields had to skyrocket to the upside to compensate these foreign investors and convince them into keep on purchasing US treasuries, right? And the US government would have gone broke, right? So it's the same stuff that I've kept on hearing a lot throughout these past recent 2 or 3 years, right? Um, Last week I made the argument for the DXY as a proxy for the overall state of the U.S. economy and government and reliability of of the government to keep on staying functional. So, spoiler alert, I disagree with Paul Tudor Jones, right? I guess it's kind of obvious if you have followed a little bit of what I say every single week over the last, I don't know, 4 weeks, 6 weeks, well, basically every time. But let's have a look at this. Now, the last inflationary spiral, well, let's call it spike. The last inflationary spike we got was after 2020 and the pandemic, because we got the PPI, the loans, the student loans forgiveness. Then we got this form of UBI with steamy checks, and supply chains were broken down, and everyone was locked in his own house, and so just a little bit of a recap, right? What we got ultimately was an imbalance in supply and demand, because that's only I mean, ultimately the main driver of inflation is always an imbalance in supply and demand. And what happened in 2020, 21, uh, we basically destroyed supply chains. And at the same time, we helicoptered money to people, right? And to businesses, right? Plus, businesses and people alike, they not only they started to save and they cut their spending, because you don't know, it's just a psychological reaction, it's a knee-jerk reaction, it's out of fear. It looks like it never happened in your lifetime. So you see the government locking you in, and you think this is the end of the world. So what am I going to do? I'm going to stop spending. I'm going to start to save because I don't know what the futures might bring. And if I got the ability of it, I'm going to draw down my line of credit. Everyone, whether you are a private citizen or a business, you might have the ability to get a line of credit with your bank. There is a maximum amount they can actually allow you to borrow from them, right? So if you're preparing for the apocalypse, I guess that would be one thing you could do. You know what? Let me borrow this money now. I don't even know if I'm going to need them, but just in case, that never happened in my lifetime, and not even my parents' lifetime. So I'm just going to do that, and then we'll see. And eventually, demand goes up, supply stayed constant, or should I say, went down, because if you break down supply chains, it's hard to get stuff, goods, and shit around. So less stuff to be bought, more money to buy it. The result is inflation. So, I mean, the price is going up. All right, everyone could get to it. Okay. Um, are we in the same type of environment right now? Because Paul Tudor Jones was not remotely, not even remotely subtly referring to the 70s. So I said, you know what? Let's have a look at what was the underlying premise in the 70s when we got the great inflation. All right. That was M2 money supply or money stock in the 70s. These are Fred database type of data points, right? So, well, I mean, more money printed, more money, well, printed. I like to say lent out into existence, but it might be a subtle difference, but it is still a difference, and it is a difference that you should not discard, right? So, okay, that sustains the inflationary premise of the 70s. Money velocity. So not only you got more money, but you also got those more money moving around throughout the system, throughout the economy quicker. Because if you check, you know, it went up. Then of course we got two or three recessions throughout those years, right? So throughout our recessions, you got the opposite, and velocity goes down because, well, people go bankrupt, people go into default, so they stop spending and velocity slows down. But overall, you can see that um, with those inflationary waves, you got the money velocity ticking up. So I said, okay, that this is, I mean, this is a good underlying premise for inflation. It was legit inflation, right? Then I looked at M2 today. So yeah, it went up 2020, right? Steamy checks, lines of credit drawn down, yeah, so more money, right? And then it flattened out. It went down a little bit, and now we are not even making new highs for these. Now this should be relatively recent because I took the screenshots just, I don't know, this morning or maybe yesterday night. So anyway, Saturday or Sunday. I guess if it's not really up to date to last Friday, it should be maybe 3, 4 days older than that. But still, these data are from this week. Let's put it this way, right? Supposedly they should be relatively recent, right? And we got what? Velocity. Hmm. Doesn't look like velocity is going up. I mean, and it's not a new thing. It's been like that since '08, right? All right, so not the same conditions of the 70s. So not inflationary in my book, at least, right? Then I checked these two variables, these two factors, matched up with, and again, thanks to Jeff Snyder at Eurodollar University, same parameters matched with the price of oil. So you see in the 70s, I just mentioned that before, the oil embargo, Yankee Poor and whatnot, right? Um, you got inflation, which is already going up, and then on top of it, you got a spike in the price of oil, and inflation keeps on going higher. And it comes back down a little bit because you got a recession, right? And then what happens? Oil goes up once again, and inflation goes up. So since oil is energy, energy is the economy, and the price of energy is reflected in everything from transportations to the manufacturing process and whatnot. It takes energy to do whatever. can't do shit without energy. So if the price of energy goes up, everything else down the road should go up accordingly. A little bit more, a little bit less, but it should go up. All right. And then I said, okay, what's happening with oil today? Oh, I mean, I'm not saying it's collapsing, but it's not going up massively, right? And again, since '08. Now these are futures, right? So there might have been a few adjustments here and there, right? But I picked this one just to highlight the trend. Slight price differences here and there if you compare it to spot, but again, the trend at the end of it should be the same, okay? And I said, all right, so three out of three, they're not sustaining the inflationary thesis. All right. Then, okay, beyond these fundamentals right here, Paul Tudor Jones talked about the problem with the debt, right? So I was, well, let's check the debt. Got to be a massive problem with this debt in the US, right? Oh, I love sarcasm. Yeah, it looks like there is a massive problem with the debt in the US. I mean, what was that? Almost 35 trillions. Wow. So okay, it's going up, and look, I don't think it's gonna come down. If anything, I think it's gonna keep on going higher. All right. The problem is that if you got more debt, then you got even more interest expenses down the road. More debt, more interests, and so what happens is that over time the amount of growth, let's say it could be GDP, right? The amount of growth that the new issued debt generates will lead to a smaller and smaller and smaller increment. Let me rephrase. The more debt you issue to finance your growth, the smaller the incremental growth will be into the future, because the more you go ahead down this path, the more in following years the amount of that growth will need to be deterred or redirected or reallocated to pay down the interests on the debt which fueled the economic growth in the first place. So to put it in words black and white, what you got is a negative multiplier. So again, you can just read it for yourself if you don't want me to explain it to you. But it's basically the same. Plus, if you consider that all of this is public debt, right? Would you expect to see the government or any other public entity, right, to be accurate, to be meticulous, to be fair, to be precise when it comes down to spending those resources or to allocate that capital? No, because it's free and you can't go bust, so there is no risk, right? Which leads to malinvestment, bad allocation of capital, and therefore it makes the economy less efficient and it creates a lot of distortions. So if I had to say anything, I would say that more debt is actually a drag on future growth. So less growth, hmm, less growth, which it's historically associated with had a little bit of an hiccup with the headset right there. I was saying less growth, which is historically associated with lower growth or income growth or wage growth. So if you earn less or if you don't keep up, will it boost aggregate demand? I'd say no. So if it doesn't boost aggregate demand and there is not enough demand to push prices higher, why should you have more inflation? Right? I kept on going and I looked at these, for instance, because uh, that's another thing that Paul Tudor Jones said. He said, which is tied with the logic about the rest of the world rejecting US treasuries, so therefore the US will be unable to keep on exporting inflation, right? Because if you look at how the system is structured now, basically the US exports dollars and import goods which are manufacturing abroad, which is why they have outsourced a lot of production. All right. But if these daisy chain actually stops, what you got is, for instance, all those dollars that they sent out into the rest of the world, we will be, how do you say that? Repatronizing? No, but basically they will get back home into the US and they will fuel a massive inflation. That would be the point. The problem is that when you think about importing inflation, you also need to think about who are you gonna import that from? Because if you look at the main trading partners of the US, I mean the Eurozone, the UK, and China, we got the same problem the US is having right now. We are in disinflation, and we are way ahead into that process. If you look at the CPI, if you look at the interest rates, we are ahead of the US in the disinflationary race to the bottom. And if you look at China, China is actually almost facing a deflationary problem right here, right now. Now, these charts, they don't include Japan, but if you look at Japan, Japan has been in a deflationary environment for 20, 30 years now. All right. So who are you going to import inflation from? I don't see it, honestly. But maybe Jones knows something that I don't know, right? Um, he went on to the deficit, so the debt to GDP ratio, right? But if you look at the debt to GDP after the pandemic, it's getting back in line with the long-term trend starting from the 80s. I mean, it's a trend, of course, it's some sort of a regression line if you want to call it that, but you see that, of course, the signal, the line, it goes above, then it comes back below, then it goes above, comes back to it, goes massively above. That's some sort of a deviation, right? It's the same as when you look at deviations from the mean, right? Sooner or later, it's going to have to gravitate back to the mean, right? It's the same stuff. So again, it's not like this is going completely parabolic. Not yet, or at least not how it was doing into the pandemic. If anything, it's actually flattening out. So is the deficit a problem, right? I mean, you also have to consider when you look at the deficit, when you look at the debt, that in the meantime, I mean, the U.S. economy actually grew, and it's currently the only one growing compared to the trading partners, right? Now, again, if you want to take, as we did in the beginning, if you want to take for good or for safe or for accurate government data, right? But anyway, um, the sure thing for me would be that even if the data are a little bit corrupted or a little bit cooked, that the US is still way better off compared to its trading partners like Europe, China, Japan, and whatnot. Okay, so again, even in here, I don't really see a case for things going out of control and spiraling out of control, right? Then if you look at money supply, all right, you see that actually money supply, once you adjust it to GDP, which means that basically you divide it for the GDP, right? And it's a little bit of a ratio, I guess. It's actually coming back down, which means that, yeah, we got more money, more currency units in circulation, right? But at the same time, we grew the economy at a point where these ratio actually went down. And if you look at the long-term trend, both for M2 money supply and for the money supply to GDP ratio, The the orange one is actually below the long-term trend, which should suggest not growth but actually contraction, and the other one is on the verge of it. So I'm not saying we're not going to see inflation. Inflation is embedded in the system, right? And it's normal to have 2.4, 2.5% inflation, right? In Western, modern, and mature economies. But again, when you say everything is leading to inflation, therefore it's going to spiral out of control, US treasuries are going to be burned to the ground, and the debt is going to be rejected, and we are not going to be able to fund our government, and the government will default. What? I don't see that. Maybe I'm blind, but I don't see that. And, he literally referred to Japan. And currently, the US has a debt to GDP ratio. What was that? It was coming back down a little bit, and it should be around 120%, 120%. Sorry. But, I mean, Japan had 263%, right? For 20 years of QE, allegedly money printing, and the result is they've just seen deflation for 30 years, and rates are basically at or around zero. Yeah, they recently tried to jack them up a little bit, but as soon as they've seen what happened in the FX market and with the carry trade, they immediately backpedaled. So I think the premise was already flawed, right? And now you take as a comparison the only one nation in the world which is the opposite manifestation of what you're talking about. It shows you that the opposite tend to happen if what you're describing is going to come, it's actually going to come. So I mean, I don't really find any reasons to be in agreement with Paul Tudor Jones, right? So I mean, then you can come up to your own conclusions, of course. These are just mine, and it could be totally wrong. At the end of it, I'm not the one which have made billions in market, right? So he might know something I don't, but I'm just looking at publicly available data, right? But this was what really drove it home for me, because Paul Tudor Jones have been interviewed naturally in the Market Wizards uh, series. Books. Well, Jack Swigert was interviewing all these huge traders, investors, hedge fund managers, and whatnot, starting out from the 80s. So the top of the top, the Premier League, right? The major league of investors and traders. And if you check, this was taken out after the crash of 87. I guess in here we were in 89, or at the end of the 80s, almost into the 90s. And if you look at what Paul Tudor Jones was saying, it's kind of what he's saying now. I mean, he said, yeah, just read this line right here, right? Basically, he said that at a point, the US, with all these money printing, debt going out of control, they would have had to to pay for it, right? And the way he puts it is that, in his view, the US would have had to learn again what financial discipline is all about, because the debt was skyrocketing and everything was going nuts. Just bear in mind, when he was talking about this stuff, if we get back a little bit, the US debt was around. Oh, actually, got. Wait a minute. When he was talking about these, the US debt in the 80, let's get to 89, 88, 89. Well, let's use January 89, right? This one right here. And the US debt was at 2. 2.7 trillion. 2.7 trillion. And then at the beginning of the 80s, the debt was fucking hell. It was below 1 trillion, right? From the 80s to the 2024, so more than 40 years, the debt went from less than 1 trillion up to 35 trillions almost. And at the same time, M2 money supply went from what was that? The yellow line should be this one right here, right? So it went from 1.3 trillion up to current level of almost 21 trillion. And throughout all of this, if you check the black line in here, which is the CPI year over year, that went from 15% down to 3.5. The 10-year yield went from what was that? Almost 16% down to 4.3. And the 30-year yield went from actually there is not data for this one, but still, if you look at the trend, they went down. And Fed funds came back down. All right. Now, notice that Fed fund is not up to date because it's still showing 5.30 something. The others, the yields are particularly in line. They are updated. And the CPI, it's not. So CPI is actually now 2.4, 2.5. So it's even lower than these. I don't know why TradingView doesn't give you the updated results. But still, you can't deny the trend. So I'm wondering, it was right. It was right on the deficit. It was right on the debt. It was right on M2 money supply. It was right on the money printer going brr. Why wasn't he right on all the rest? On yields, on inflations, on the problems that the US government would have faced when it comes down to fund itself. So if he was wrong 30, 40 years ago, and if the conditions are still the same, why should he be right now? What changed? Or maybe what does he see that is about to change that we don't see? All right? Because if you present the thesis like this, to me, it's completely inaccurate. And it doesn't hold the test of scrutiny. And it just it just invalidated, but by 40 years of history. I think, and this is just me, of course, but I think what is not taken into the account is that the US debt and the US dollar are part of are basically two layers of the global reserve currency. All right. So if you think about foreigners, could be foreign banks, institutions, and whatnot, you now I'm not patronizing American people, all right? I'm just trying because again that always happens to me when I'm talking with someone which is from the US, and it's totally understandable because for them it takes a completely different type of nuance and perspective. So basically what they say is, I don't like this because I only see my purchasing power domestically for the US dollar to be depleted. And I totally get it. It's totally right. What what I wanna try to put a little bit of a light on is that for us, for foreigners, we don't care. We don't care about the purchasing power of the US in the United States. We don't care about the inflation rate in the United States because whatever you're suffering at home, we are suffering that plus 2, 3, 4, 5, 10, 20, 50 abroad. So for us, your dirty shirt, it's always the cleanest in the bucket of dirty shirts. All right, which is why we keep on buying your debt, and we have kept on buying your debts for 40 years. All right, think about it this way. Think about a bank or a financial institution outside of the US. All right, and as a bank here in Europe, I might have my depositors, which of course are depositing their funds, their money with me. And for me as a bank, those money are liabilities because they are just an expression of a debt that I have toward these depositors. They could come in and ask the money back, and I should be able to provide them with that. So to me, that's a liability. How can I match that liability with an asset? Hmm, I'm going to buy US Treasury. Why not? The, the government can't go bust because no government can actually go bust. I mean, you can't default in a denomination, in a currency you have the ability to print. You can't default nominally. I'm not saying it's good. Probably the money, the basement will be huge, but you can't technically default. You just print the difference. All right? Just a little aside there. But for me, I take these treasuries and I say, you know what? I know that at maturity, I'm going to have the principal plus interests, so why not? At least I got something which is offsetting the liability that I have with my clients and customers with an asset on my balance sheet. All right. And I pick, let's say, a 2 years maturity because I run the numbers and I see that on average, my clients keep their money with me for no more than 2 years, or at least the huge outflows are in that time span. So I'm just trying to match up the amount and the duration of assets and liabilities. On top of it, right, I'm paying to my clients. So basically, the active interest rates you receive from your bank if you are a customer, a depositor, right? I'm paying them, let's say, 1%, maybe less, right? Have you checked your statement at the end of every single year? How much active interest rates your bank is paying you, right, on your checking account? But look at that. I can pay them 1% for the money that I basically borrow from them. I can receive a 3-4% from the US government. That is great. I'm pocketing a 2-3% spread. And if I start doing it on millions and billions and trillions, I'm making huge money for free. I'm making the big money for free. There is no risk involved. I mean, sure, there's always a risk involved. The US government going bust is a non-zero chance event, but compared to all the other type of risks you can look around and you can see around in the global and financial system, why not, right? So again, um, that's why we have always kept on buying that debt, right? Plus, I do know that for me, outside of the US, these treasuries, they are like cash. They are as good as cash, because they are easily convertible. It's no mystery. They have been called cash equivalent. Maybe not for you, maybe not for me in the real world, but in the financial system, with another bank, with another financial institution, we can settle just moving around these assets instead of moving actual cash. Also because there is no actual cash, it's all figures on a monitor, right? But just that's the gist of it, all right? And what happens if all of a sudden, because everyone is talking about supply, too much debt, so it means that the supply of treasury is going to skyrocket. Janet Yellen is going to issue another 3 trillions of US treasuries, and therefore the rest of the world will demand a higher yield on them in order to purchase them. Is it? I mean, if I'm already cool with it right now, where interest rates are what, 4%, right? Let's say Janet Yellen comes in, loads the market with another 3, 4, 5 trillions of these treasuries, and for supply demand dynamics and for the inverse relationships in between the price of the underlying asset and the yield, let's say the yield goes up to 5-6%. how many treasuries should I buy as a foreigner? Again, the example is based on the rest of the world. I was more than happy to buy them at 4%. Why shouldn't I be happy to buy them at 5, 6%? I'm still paying my depositors 1% for their deposits. If now these treasuries are yielding me 4, 5, 6%, the spread I'm pocketing on the interest rates differential is even wider. So it's even a bigger gain for me. I'm gonna buy all of them as much as I can, right? So again, this is in a nutshell. I mean, not really a nutshell, but at the end of it, this is why I think Paul Tudor Jones is wrong. But I'm gonna leave you with this. He might be wrong. All right, maybe he is. Who knows? I think he is, based on these data. Just think about something for a minute. Is he wrong? Is he just gone mental all of a sudden? Didn't he learn from his mistakes back in the late 80s? Is he so stubborn that he doesn't want to admit he was wrong before, he is wrong now? Or is he very clever? Think about these two potential scenarios. Paul Tudor Jones is already short bonds because he thinks, at least in the short term, they're going to go down. So he's already short. Maybe he shorted right after the first Fed rate cut, and he's been short ever since. What would be his incentive? To talk down the bonds. So price keep on going down, and he keeps on making more money. Right? Why didn't he come up with this interview ahead of the September 18th Fed cut? Why not the day immediately after that? Why he came up with it only after the first half of October? So more than 1 month later, and he's a very short-term trader, right? He's not, at least based on what I read, he's not a position trader. He takes these huge positions and he hold to them for like 1 month, 2 months, 3 months, right? But still short term, right? So we're not talking long term investing, right? Could it be he's talking his book a little bit? Or I'll give you another scenario. Maybe he have learned from his mistakes back in the late 80s, and he knows that eventually interest rates are going to come back down. Therefore, it could be good to park some money into US Treasuries. But the problem is, he was a little bit late to the party. US Treasuries had a huge run up in 2023 at the end of the year, and then they have another huge run up in the middle of 2024, and maybe he didn't want to buy at these levels. So he sees the opportunity now to down talk a little bit these assets, hoping that price can get back down a little bit more and he can have advantageous prices to load up. Which one of the two would you pick? For me, they're both valid. I don't know what he's really up to. I'm just saying, if you start thinking about it, if someone like me can get to it, would you assume Paul Tudor Jones is has just gone completely retarded? Would you assume he got Alzheimer? I don't. So at the end of it, beside the provoking thumbnail and title and whatnot, I think there must be something that he knows or he wants, but he's not willing to admit it out loud for one reason or the other. There must be a secondary incentive structure because these people, they would you think they would be there giving you advices for free? Would you think they would feed the entire market they are playing against with privileged information they already know something about it? just to make you a favor? I don't think so. So this is why eventually I think there is a serious possibility that he's not a fool, he's not a liar, he's just very, very clever. All right? So just bear it in mind. I know it was a long video, but I wanted to talk about this thing about Paul Tudor Jones, to be honest with you. All right. So with that, I wish you a nice rest of your Sunday, and as usual, getting into next week. Uh, Pay attention, sticking your neck out with the volatility, which most likely we are about to see. And as always, be nice and be cool. Neil's out.